So we're looking at the risk from investing in bonds. I do want to state that bonds are less riskier than buying stock, but there is still some risk involved in the bond investment market. Okay? So again, default risk is the risk that the borrower of funds will not repay the creditors. So that's what we call a risk premium, the extra year required by investors to compensate for the risk of default. You've heard the phrase, the higher the risk, the higher the reward. So some investors are willing to invest in companies who are not that stable financially in exchange for a higher return known as a risk premium. Okay? So there are risk ratings to measure the default risk. So bond companies or companies issuing bonds are going to be rated. They're rated by two main companies. One is called Moody's Investor Services. The other is called Standard and Poor's. These are the two most common bond rating agencies. They pretty much set the standards when it comes to bond ratings. And the ratings issued by this company will reflect the risk of buying bonds in these different type of companies. Okay? We'll take a look at it in a few minutes. Impact of the financial crisis on default risk. So back in 2008, 2009, we had a financial crisis in the United States. There was a crisis in the mortgage industry, which led to a financial crisis for a lot of companies. So many firms at that time experienced financial problems and were unable to make the bond payments. So the money that was owed to the bondholders for some corporations, they didn't receive it. Okay? Relationship of risk rating to risk premium. The lower the risk rating, the higher the risk premium offered on a bond. So again, companies are going to receive ratings by, again, Moody's and Standard & Poor's are the two industry tone setters, if you will. And they're going to rate every company as issuing bonds. And if you get a lower rating, which we'll take a look at, it means you must pay a higher premium. The economy condition does have an impact on interest rates and default. You're going to have a higher risk of default when economic conditions are weak. So right now, we're in a current pandemic that's impacting companies financially. We have to wait and see what would be the overall impact of this pandemic on the country's overall finances, and we'll have to see how will it impact the bond market overall. Okay, so here we have the ratings. I have a question for you. What does bonds and students have in common? They both receive grades. They're both going to be rated. Okay, a little early morning humor. So here we have the ratings. It goes from triple A down to triple D for Standard & Poor's. Moody's have triple A ratings down to a C rating. Okay? So if you have a triple A rating, highest quality, those companies are strong financially, there's little risk. So if you buy a bond with a triple A rating, you feel pretty confident that you're going to receive what's owed to you from that company because they have a good history of paying what's owed to their bondholder and they're strong financially. As the ratings go down from A's to B's to C's to D's, now you're looking at companies with low quality, poor quality, or very poor quality, meaning that they have either defaulted on bonds in the past or they're just not that strong from a financial standpoint. So you're taking on more risk if you're buying. So if it's a D quality, just like in school, D's are not good, right? Lowest quality, that means that you're taking on a lot of risk if you're buying bonds from these companies. In exchange for your risk, you're going to require a higher yield, a higher return on your investments. So before you decide to purchase bonds, find out what is their bond rating and let that be a factor in your decision-making process. Okay? A call prepayment risk. So just like stocks, some bonds can be callable, meaning that the bond can be retired before its maturity date. So a bond may have a 10-year maturity date, meaning that the bond matures after 10 years. But if that bond has a callable bond, it means that the bondholder can redeem that bond before 10 years. So maybe after 4 years, they may decide to pay the money owed to the bondholder. Interest rate risk. The risk that a bond's price will decline in response to an increase in interest rates. So what we're saying here is that, once again, when your bond is first issued, it is issued at a set coupon rate. That rate cannot be changed. But over time, as other bonds enter into the bond market, the current yield, the current interest rate can increase. And if the current interest rate increases, that will cause the price of your bond to decrease. So when you are purchasing long-term bonds that may mature for, say, 20 years from now, you're taking on more interest rate risk because bonds with lower terms are more sensitive to interest rate movement. So of course the rates are going to change over a 20-year time period. They could go up, they could go down, but the longer the maturity date, you're taking up more interest rate risk because you can't predict the interest rate 10 years from now. Okay? Select an appropriate bond maturity, meaning how long do I want to hold these bonds? Well, choose maturities reflect expectation on future interest rate. So if a bond is paying a 5% interest rate, we try to project how long do we think that 5% rate is going to be intact. Do we think rates are going to go up or if rates are going to go down? So perhaps we say, well, we think for the next 5 years, rates are going to end up decreasing. Then okay, then let's buy a bond that matures in 5 years. Because at that point, I'm getting a higher interest rate now before the bond prices start to go up. Now, consider investing in bonds that have maturity that matches the time you would need the funds. So bonds are a form of long-term investment. So let's say that I plan to build a new facility in 10 years. Then I may purchase a bond with a 10-year maturity so that by the time that 10-year period has expired, I can use those bond funds to build or purchase my new facility. Okay? Interest rate strategy, selecting bonds based upon interest rate expectations. Okay? So you would purchase long-term bonds if you think interest rates are going to fall. So if I think rates are going to get lower over time, I'm going to purchase a bond now where it's yielding a higher rate of return. Or I can be passive. I can invest in a diversified portfolio of bonds. I mean, I'm going to have different bonds. I'm going to purchase bonds at different time periods. So if the rates are going up or rates are going down, I'm constantly acquiring different bonds, putting them all together in my portfolio. So that's kind of what we call a passive strategy, where you're investing in different bonds over different time periods so that if rates do fluctuate, you have bonds that you purchase in those different time periods. Okay? Maturity matching strategy. Again, investing in bonds that will generate payments to match future expenses. So, for example, if I know that my child is going to college in the next 10 years, the next 15 years, I may purchase a bond that will mature right at the time they're going to leave for school so that I can use those funds to pay for their college education. Okay? Key decision you're going to make about your financial plan about bonds. First, should you consider buying bonds? So, again, bonds are a form of investment. They're known as debt securities. They're going to offer you a specified return on your investment. Typically, the rates will be lower than in the stock market, but you do know the rate of return and it's guaranteed rate of return. What strategy should you use for investing in bonds? So you can do a strategy based upon interest rate strategy, trying to predict the interest rate, whether they're going to fluctuate, go up and down. A passive strategy, where you're going to purchase the bonds at different time periods to try to cover the fluctuation in interest rate, or a maturity matching strategy where you want to make sure that those bonds are going to mature at the time that you're going to need those funds to match your expenses. So you can look at these different type of strategies before you decide if you want to invest in the bond market. Okay? And that will conclude pretty much our discussion on the bond market. So again, hopefully this information has been very beneficial. You know more about the stock market, but it doesn't, hurt to look at the bond market again. You can buy bonds. Sometimes a bond can be close to $1,000. And again, although they pay often there's a lower return than in the stock market, but with the bond, you have less risk than you have when you invest in stocks. Okay? So with that, that will conclude our chapter 16 lecture. Bye-bye.